Welcome to XM.com. You're watching today's Daily Market Comment by Mario Sajikiriakos. I'm Christina Marujos. The minutes of the latest FOMC meeting poured gasoline on the bond market bonfire yesterday, slingshotting U.S. yields even higher as traders braced for a full-speed normalization of monetary policy. Officials highlighted the prospect of raising interest rates in 50 basis point increments and generally agreed that the balance sheet should be reduced by roughly $95 billion per month starting in May. That is a much faster clip than last time, which essentially means the Fed will be withdrawing liquidity from the financial system at an unprecedented pace. Ultimately, this process argues for higher Treasury yields on the longer end of the curve, spelling trouble for equity markets as investors move back towards the conservative side of the risk spectrum. Consequently, Wall Street suffered another bruising session. The Fed-sensitive Nasdaq lost 2.2%, with tech and growth shares getting smoked. This is really the bear case for stocks. The bull case is that inflation might cool later this year as fiscal and monetary stimulus fades, supply chains heal, and energy prices cool down, allowing the Fed to raise rates slower than what's currently baked into money markets. In the FX domain, King Dollar has reclaimed its throne with a little help from rate differentials that continue to widen to its benefit. In contrast, the yen has drawn the shortest straw in the market rotation as the Bank of Japan doubles down on its yield curve control strategy that prevents Japanese yields from participating in the global rally. In the commodity complex, oil prices took a sharp hit after the International Energy Agency announced that its member countries will step up the release of strategic reserves to counter the energy shortage. Meanwhile, gold remains trapped in its recent range, unscathed by the epic sell-off in bond markets. The minutes of the latest ECB meeting will be in the spotlight today. The single currency remains under heavy pressure, keeping one eye on the war and another on the looming French election. Opinion polls have narrowed, and a victory for President Macron doesn't look so certain anymore. Markets are starting to get nervous, something evident by the ballooning spread between French and German bond yields, as well as the spike in implied volatility in euro-dollar options, which reflects growing demand for hedging. Thank you for watching the Daily Market Comment here at XM.com.